the sun, I'm rising up, I feel the love now. Oh, it's in my vision. You know I ran around and I got lost, but now I found it. Well, I can't shake this feeling. Oh, it's gonna take me a little while just to get my head around this moment. But I can see the sun, I'm rising up, I feel the love now. Oh, it's in my vision. And it's telling me run, 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 run. Run, 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 don't give up. And it's telling me run, 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 run. Run, 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 and don't give up.
Welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and this is the daily NASDAQ stock update. We have a lot of really good information to bring you today. The two stocks that we're going to be talking about are quite unique because the very first company is a genome sequencing company. And then the second company is a drug manufacturer, and it's a very specific and specialty drug manufacturer. So let's get right into talking about these two different companies today. Now, the first company, I want to describe it to you in this way. Let's say that you are thinking that you want to invest in a medical development company, something that is going to be innovative, that's going to be bringing a lot of good to humanity from that standpoint. What if I told you that there is a company out there that can actually map DNA, that can map the human genome? This is that particular company. This company actually dominates that particular market in itself. They represent around 70% of the genome mapping market. Now, that's actually a pretty big market from that standpoint. And it's not just, you may have heard of Ancestry.com, and you've heard of 23andMe, and there's a lot of other different very popular uses for mapping the human genome, but there's a lot of very medically specific things that are out there. If there's a child that has a genetic disease, mapping the human genome can help them so that they can be treated. There is more development that's going on right now that it boggles the mind, where that they can pinpoint within the genes and treat diseases specifically based on that. There are cancer developments that are happening in cancer treatments, and that's really what we're going to be talking about with this particular company today. The company that I'm referring to is called Illumina. Now, yeah, they did end up the day down with a lot of the rest of the market, but let me tell you what, if your retirement strategy, if your saving strategy is living and dying by what's announced on the mainstream media news about what the stock market did today and what one particular investment did today, then you're picking the wrong strategy. You need to have a strategy that you can develop over the long term. Let me tell you what, this is the way that a lot of people pick stocks, and it's the wrong way. Watch. If you pick stocks like you're playing whack-a-mole, that's basically wrong, because what you're doing is you're listening to the news people, you're listening to the day traders, and you're saying, hey, I'd like to buy that particular stock. Develop a strategy. Our purpose in this show is to teach you a little bit about some of the different stocks that are in the NASDAQ 100. We pick apart two of them every day so that you can understand what they do, and then you can develop a diversified strategy where that you can pick a particular strategy of saving money so that you can save money towards retirement, or you can create an income for retirement. That's the whole idea here. Yeah, we're going to teach you a little bit about the ins and outs of some of these companies and what what to look for as far as their profitability goes from that standpoint. Now, there's really three things that we look for when we are investigating companies and looking at the strength of them. First of that is going to be earnings growth. The second is going to be how they perform within their particular industry. And then the third thing is going to be stability. So let's get right into talking about the stocks that we're going to address today. And the very first one, as I mentioned and started off with, is Illumina. As we go back a year, you can see what happened in Illumina today. Actually, this should go down just a little bit because they lost a little bit today. But generally speaking, over the past 12 months, they've had a profitable year. They started a year ago on September 10, 2019 at $264.56. And today they ended up at $346.11. That's an increase of 30.82%. Now, some of the analysts that we're going to look at today, these are the people that their job is analyzing these stocks on a daily basis. Some of them are going to say that this particular stock is overpriced at this point in time. To some degree, I kind of agree with them from that point of view, but you have to understand that sometimes with a stock that's considered a growth stock, which that's what this is. This is a stock which is actually trading over top of what its fair market value is supposed to be. So that's more of a growth stock. In stocks like these, they'll continue to grow sometimes. Heck, look at Apple. Apple's continued to grow far beyond what its actual value is. Tesla's another one. Tesla went up 50% just because of a stock split, which means nothing. So you have to be careful from that standpoint. You have to put your strategy together so that it lasts a long time. I had one gentleman that wrote into me earlier in the week and he said, I'm retired and I've got some money that's invested, and he gave me a particular stock and he said, should I go ahead and take some of the profits off the table because I'm going to be using this money before too long, or I'm going to want to use it for income? And I told him, absolutely. You should be taking that off the table if you're going to be using it anywhere in between the next 3 and 5 years. Might you miss some growth that's out there? Yes, you might. But let me tell you what, the drop that you could possibly see with the elections coming up, there's anything that can happen from that standpoint. So if you're going to use money in the short term, and I term short term as like 3 to 5 years at least, if you're going to use money anytime in that time period, you need to take it off the table and put it in something that's more conservative so that it won't move around quite as much. Now, if you've got questions, enter them into the whatever platform you're listening to. I'll be glad to take time and answer them, usually at the very end of the show. And if we run out of time, I'll be sure to bring them up tomorrow or send you something directly from that standpoint. So let's keep moving on and see what's been going on with Illumina. As we look at the stock in itself, again, we want to look at its earnings. Now, the thick blue line that you see the dancing cursor around, it goes back over the quarterly profits. Now, this company does not pay a dividend. So if you're looking for a dividend stock, this is not the one. But their earnings per share has actually beat whatever the expectations have been from the analysts pretty consistently, except for the last quarter. Actually, that would be the second quarter of this year. And the reason, heck, I think you know why, was because of the coronavirus. It was because of the shutdown. There weren't as many people that were going into the office. So they weren't even going into doctors' offices for visits. But that market has started to come back, and it probably is not going to be a long-term problem from that standpoint. But generally speaking, the earnings history of this company has been pretty consistent from that standpoint. Okay, as we move along, I told you that there was no dividends, so we're not going to ponder on that. But we want to see how Illumina stacks up with its competitors. So who are their competitors? There's another company that's called Qgen. There's Fluigem. There's Pacific Biosciences of California. Now, when you look at these companies, you're going to see if you look, follow the blue, you'll see the blue is where Illumina is. Illumina has been pretty, if you were to map this beside the S&P 500, it's fit with it pretty well from that standpoint. But you're going to look at a company like Fluigem and Qgen, and you're going to see that there's going to be a lot more volatility in those stocks. Look at the green line. See what's going on here. Look at the gold line. There's going to be a lot more volatility here. One of the biggest reasons is because these companies are specialty companies. Yes, Illumina is a specialty company, but it's a huge specialty company. Look at the size of this company. Illumina is a $51.3 billion company. It does not fluctuate as much as a company like Fluigem that is worth only $475 million. Now, you saw Fluigem in the last quarter had a spike up and then it dropped. That happens a lot with smaller companies, especially when they're in the development of drugs and a drug either makes it or doesn't. So I'm not sure exactly what the story was with that increase and drop, but you have to be more sensitive to what smaller stocks will give you and be aware that if you're going to invest in smaller stocks, you can also see more swings in the value. Now, when I show you the past performance of these stocks, you have to always understand that the past performance is not a guarantee of the future results. Now, we want to look also at the stability of companies when we're analyzing them. And one of the things that we do every day is we look at the moat of a company. Now, what exactly is the moat? Remember that the moat is the barrier that a company has dug between them and their competition. And if they've dug a deep moat, then the competition is not going to bother them that much. Now, in the case of Illumina, Illumina only has a narrow moat. Now, let's talk about why that moat might be narrow. Because, frankly, if you're going to be building a company that's going to do human genome sequencing, it's going to take a huge investment actually to come up with this particular strategy of mapping the human genome. Took billions of dollars. They've decreased it and they've got several patents that are in place, but replicating it is very difficult. However, there are some reasons why that the stability of the company could be threatened. Now, I mentioned this a little bit earlier, and that is that Illumina actually occupies about 70% of the human genome sequencing market from that standpoint. I've talked about the fact that it's difficult to duplicate. Another thing that competitors have to worry about is the accuracy of the reporting. Now, if you've watched any TV show that's had to do with DNA identification, you know that they talk about the accuracy of matching DNA. The particular type of test that they do or the testing company has a big influence on the reliability of genome sequencing. So the newer companies don't have the accuracy that the testing at Illumina does. So that is actually a big advantage for Illumina. Now, you might think that they actually warrant a wider moat rather than a narrow moat, but they really don't, because disruptive technology from other companies that are coming up with new ways of mapping the human genome threaten the profitability of this company in the long run. I mean, you could be investing in a company like this and all of a sudden another company comes up with something that's dramatically cheaper and more effective, perhaps even more accurate, and makes the value of this company quite a bit less. That's probably not going to happen as much. Another reason why that they have a narrow moat is because of the drop in earnings in the second quarter, but we all know that was because of the coronavirus. So as we move on down the road, we actually look at what companies like Morningstar say about Illumina. And as we peg today's value at 346.11, what Morningstar is saying is they're looking at the earnings per share and they're taking the fair market value that they are projecting and saying that it is a multiple of the earnings per share. And what they're saying is that this particular stock is only valued really at $285 a share, which really would mean that it's selling for a 21.44% premium. That means it's selling over top of what its fair market value is. So that really pegs it at just 2 stars. Now, when we look at what some of the other analysts out there are saying about this particular stock, in a poll of analysts, of 14 different analysts, we saw that there were 6 of them that were saying that it was a strong buy. There were 5 of them that was saying that it was a hold. We had 2 that had a moderate sell and 1 that had a moderate sell, and then we had 1 that had 2 had a strong sell. I'll get that out here in just a moment. So when we average all of that out, the way that we do that is, the way the math works out is we take on a scale of 1 to 5, each analyst gives it a particular number, and what the average comes out that tells us is this. That tells us that this is a moderate buy. It's not a strong buy, it's a moderate buy. So we're just looking at what the particular analysts say about that particular stock. Now, I want to remind you that what I'm telling you today is not a direct recommendation to go out and buy this particular stock. Remember, the reason why that we're doing this is to teach you a little bit more about some of these different stocks, so that when we get to the point of discussing your portfolio and how it should be structured, that when I say, you know, we need to have drug stocks in here and we need to have tech stocks in here, and we don't want to have these particular stocks in here, and we talk about your preferences and what your vision is, then you'll understand why the recommendation is being made to you. So let's keep going on and talking about the different stocks. Now, the next stock that we're going to talk about is a drug manufacturer. They're just not a company that does testing like Illumina does, or creating testing processes like Illumina does. This company develops what they refer to it as small molecule drugs for oncology. They treat different types of blood cancers. They also develop drugs for inflammation. Inflammation is primarily for rheumatoid arthritis, and autoimmunity, they develop drugs for lymphoma. And you might not be familiar with this company, but it is really a significant company in this particular arena, and the name of the company is called Incyte Corporation. Yes, they were down today by 3.55%, but remember, the whole idea here is to understand what the stock's potential is, so that you will be able to understand why it's been put into your strategy. And when you're picking stocks for retirement, remember, there's only 3 reasons why you pick them. If you've watched me before, you know what they are. Number 1 is going to be growth. If you're trying to fill that bucket for 20 years from now, even if you're 60, you have to think of spending money at the age of 70. So you have to have some growth that's in there. If you are looking for dividends, you want to be having stocks that are dividend paying stocks. That's not these, by the way, for today. And then the third reason is generally diversification. There are some people out there that just like the idea of trading stocks, and that's quite all right too. So as we go along and we look at what this company has done over the past year, we're going to go back a year and look at what its value was in September 10th of 2019. It was at that point in time $78.37. Now, I'm going to remind you that if you're listening to this on a replay, feel free to type in your questions, because I love questions. I'll be sure to get back with you, or I'll bring them up in tomorrow's broadcast and we'll talk about them a little bit. If we have some time today and we've got some different questions, I could bring those in today too. So if we look at what it closed at today, this stock closed at 88.26. So the past year, it hasn't been quite as profitable as Illumina, although it is in the positive at 12.62%. I remember the day when a 12% rate of return would have been a great thing. And I'd like to encourage you that if you're thinking of a long-term average rate of return, that you look at more in the single digits for retirement. For growth, yes, we can look at some better growth records from that standpoint. But don't be sucked into the trap of expecting that you're going to get these huge rates of return forever. You're not going to get 30 or 40% rates of return. There's nobody that has a magic crystal ball that's going to be able to say, this is the stock to buy. It doesn't matter whether it's Jim Cramer or Dave Portnoy or whomever it's going to be. You have to have a strategy, though. And if you have a strategy and you stick to it, it will help you to avoid running out of money during retirement. So let's keep moving on and looking at these particular stocks. Remember, I told you there's no dividends on this stock, so we're going to keep going on. One of the pinnacles, one of the peers of a stock is going to be its earnings per share. And if we look at this particular stock, you follow the thick blue line, we go back all the way to 2014, and we can see the profitability of this stock has been actually really pretty good. Yeah, what happened over here in the second quarter, it was the coronavirus market crash. Everybody had problems from that standpoint. So this one did too. As we keep going on, though, we can see as we've gone on that it's actually had pretty good profitability. When we compare it to its peers, well, who are its peers? Insight Corporation, Ionis Pharmaceuticals, and Lagon Pharmaceuticals. These are all companies that do things similar to Insight. You're going to see that these are smaller companies in the realm of pharmaceutical companies. There are great big companies. We're going to look at a couple of those just in a second, just to give you some comparison from this standpoint. But you're going to see that there's a lot of volatility that's been going on from this. If this is not for you, then the idea is that you want to develop something that's not going to have volatility. You have to be able to accept volatility in the short term for the long-term gain. That's the way that we look at this. I want to train people. I want to educate them to be investors, not speculators. But with that understand that smaller stocks will be more volatile than larger stocks. And although that these companies are in the billions, you can see that Insight is close to $20 billion. It's had a little bit more stability than some of the other companies. Ionis Pharmaceuticals has probably been one of the more volatile ones. And if you think back to the other companies that we compared to Illumina, some of them that were in the hundreds of millions of dollars, they were even more volatile because they are susceptible to certain drug success or failure. These companies that have several drugs in their portfolio, if one of them has a problem or one of them doesn't do as well, then the other drugs are going to basically make up for it as far as an investment standpoint. Now, if we compare it to some other big companies like Merck and Company and Pfizer, I put them up here a little bit fast, but if you follow like the I don't know what color that would be. It's kind of a purplish color. You can see that it has actually been more stable than some of the smaller companies. And the same thing is going to be true with Pfizer that's in gray. These are hundreds of billions compared to maybe 19 or 7 billion from that standpoint. Now, I know that's still a whole lot of money, but when we talk about investments, it's not that uncommon. Remember, though, as we go through all this, the past performance of these investments is in no way going to be an indicator of what their future guarantees may be. There's actually no guarantees associated with it. So we also want to look at the stability. We want to look at the moat that's there. We talked about what the moat was just a moment ago, so I'm not going to go through that again. But the idea is, when we have a company like Insight actually has a wide moat. The reason why that they have a wide moat is because of the type of drugs that they develop. They have had extreme success in oncology and autoimmune drugs. The blood cancer treatment, the oncology treatment, Jakafi, is extremely successful, and it's one of the only ones that's out there. Regretfully, if you're a patient that if you need this drug, it's about $90,000 a year. When we look at treatment for lymphoma, Monjuvi is one of the more successful drugs that this company has for that, and it's one of the hallmark drugs that's available for treating lymphoma. And Monjuvi is about $200,000 per patient. These drugs are very difficult to replicate, and they're pretty stable as far as making profits for the company in itself. When we look at what Insight's current value is and what their fair market value is based on earnings, they're actually trading below what their fair market value is projected by Morningstar. Remember, the fair market value is calculated by a multiple of earnings. So this drug actually, not this drug, but actually this company, as compared to Illumina, is trading at a discount. Where Illumina was trading at a premium, this company is actually trading at a 20.49% discount. That means it's under. And as a result, Morningstar gives them a 4-star rating. Now, what do the other analysts say about this particular stock? Now, this is really an interesting part, because sometimes we'll look at what Morningstar says, and Morningstar's throwing up 4 stars, and you're thinking 4 stars, Gordon Ramsay, great food. I don't know. Maybe that's what you think of. Maybe it isn't, but it's not like you're going to a 4-star hotel. It's not that you're going to expect a fantastic result. Results are not guaranteed. The star system is there because of the fair market value, the earnings per share. That's why the star system's there. When you have a stock that's trading under its fair market value, then it's going to be a higher star rating from that standpoint. But when we look at what the other analysts, there are 15 analysts that have looked at this particular stock, and they have said 10 of them are just saying it's a hold, 5 of them are saying that it's a buy. And when we average all that out, it comes out to be this. What most of them are saying is that it's a moderate buy. But I do want to remind you too that this is not my recommendation to you to go out and buy or sell this stock. I'm just reporting to you and educating you on what the average analyst is saying about this particular stock. Okay, so I tell you what, that brings us to the very end of the day. It was a pretty quick 25, 26 minutes. Remember that if you need help with your retirement program, go over your personal retirement. I do company retirements too, or help people with that, companies with that. But if you need help with your retirement, you want somebody to talk to, I can set aside some time. I've set aside time on a calendar to do that. It doesn't cost a penny. We can have a conversation over the telephone for about 15 or 20 minutes. And if you want to take advantage of that, if you want to take me up on that offer, go to my website at richardsfinancialplanning.com, and you're going to see that blue teal button, just like you're seeing right here. And if you click on that, you can find a time that I'll contact you, and we'll set up a time, or I'll contact you at the time that we set up there and have a conversation about it. Once you click on that, it's going to tell you what you should probably do in preparation for our conversation so that it's more productive. Remember, there's no obligation, then there's no cost to do this. So feel free to. So with all of that, I'm going to say thank you very much, and I appreciate the time that you've spent with me today. And remember, there's a disclosure which is coming up, and I hope to see you tomorrow. Have a good day.